So, welcome back. A few things that we did learn in chapter 1 is going to be the nature of the business, but also the key factor here is also understanding there are 5 different business organizations, okay? Right? These 5 with the little key points here pretty much gives you a little brief description of the differences between these different organizations. Make sure you know all 5, okay? Again, sole proprietor, which is only one person. Partnership, which is 2 or more people. And you have 2 different types of partnerships, right? A general partnership and a limited liability partnership. In this case, right, you don't need to know super details into which is which, especially for partnerships, because I'm not going to test you on the difference between partnerships. I'm just going to test you on the overall, if you know what a partnership is, so at least 2 or more people, okay? And then we're going to talk about corporations, okay, limited liability companies, and again, non-profit organizations, okay? I just need you to recognize what they are and that there is a difference between the 5. That's it, okay? And make sure that you understand that this class that I'm teaching you in this course, we are only focusing on sole proprietorship. Okay? We're not going to look at partnerships. We're not going to look at corporations just because those are a little advanced and higher level of accounting. Okay? If you go to a college, you will learn corporation and the smaller businesses at the same time. Okay? But for this class, right, we're starting you off from the very, very beginning. So we're going to be looking at sole proprietor as our example of what kind of business we're going to take a look at and do bookkeeping for. Okay. We also talked about the 3 different types of business activities. Okay. Excuse me. So therefore, in this class, you will learn similar to what sales for a retail store is going to be. So we're looking at kind of a merchandising type of business activity. We're not looking at manufacturing. That's going to be, again, another advanced level of accounting. That's called cost accounting. And services. Services is kind of given, especially when we have... it's very straightforward, if that makes sense. But in this class, we're focusing mostly primarily on merchandising inventory and merchandising type of business activity, because in chapter 5 and chapter 6, we learn about how to purchase merchandise and how to sell it. Right? You need to know the definition of what accounting is and know the difference between the bookkeeper and the accountant, right? The bookkeeper only strictly records transactions, while the accountant does pretty much everything. They're the ones who analyzes the materials. They're the one who create the financial statements. They're the one who creates the rules on how to journalize and so on and so forth. Okay? We also talked about the 4 major business financial statements. Right? We understand that there are these 4 are very important, especially when it comes into looking at the the composition of the business itself, but also to look at how the business is doing well, whether it's profit wise or net worth. Okay. And last but not least, we learned about the 5 areas of accounting. All right. Public, private, government, non-profit, and international. Okay. But here today, because of the, once again, you need to go into higher levels of accounting to understand the rest of them. But where we're starting at is going to start off at the private sector, okay? You do need to pursue a CPA in order to do public accounting, okay, which is for the publicly traded firms, okay, or publicly traded companies. So any corporation will require public accounting, where we're looking at a smaller private sector, okay? So that is exactly what we are focusing on. All right. Then once again, chapter 2, we talked about, again, the definition of accounting. We talked about the accounting equation. So assets equals liabilities plus equity, all right? We talked about the accounting model where each account flows in a specific direction, okay? So we have our assets and our expenses, right? They're normally increased with a debit, right? While all the other ones, the liabilities, the equity, and the revenues, all are increased by a credit, okay? That's very important that you know this because that is called the normal balance, where it is the positive side which each account increases on, okay? So in this case, right, if I tell you what's the normal balance of a liability, right, if you can figure out that it normally increases with a credit, then it would be a credit balance, okay? Again, left means debit, right means credit, okay? And then we talked about the difference between temporary and permanent accounts, okay? We talked about each section, your assets, liabilities, and your equity, also known as your permanent accounts, right? We talked about categories that belong in each and every single one, okay? So you have, again, your current fixed and other assets, and then you have your current and long-term liabilities, and equity has no categories, okay? But you have some examples here. For temporary accounts, once again, you have income, or also known as revenue, whichever one that you want to refer to. They're both interchangeable, okay? And you have your expenses, okay? Again, they both have operating and non-operating expenses or other, okay? And they have also, for expenses, you have an extra category called cost of goods sold, okay, which is directly correlated to inventory, okay? So those are your temporary accounts. These close out at the end of a given accounting period, okay? Then we talked about chapter 3, which we talked about how, the general journal is structured, okay? We talked about the chart of accounts, which is a list of all the accounts that exist for you to sort out and basically to organize your business transactions based on an account, okay? We talked about the difference between the general journal and the general ledger, right? The general journal and the ledger are identical in tables. The only difference here is that you have an extra 2 columns to determine what the account balance is at any given time, okay? And the list of the general ledger is listed based on every single account that exists in your chart of accounts. So every time you enter in something in a journal, you're going to place it into your ledger so that you have a running balance at any given time. While the basics of the general journal, which is going to be pretty much the main core of this class, is to help you determine how a business transaction is going to be categorized and organized into these separate accounts by using the accounting model, right, as well as the transaction analysis to determine where things go, how to use the debit credit system, and so on and so forth, okay? So again, we're going to be walking you through every single chapter is going to have a journal entry, okay? And what our job is to do is just to be able to figure it out, okay? And of course, T accounts don't really matter in this class. It's just there. I just put it there as our little small reference point. But again, you do need to know how to correctly correct a journal entry. So making sure you know the difference between the reverse and re-entry method, as well as the error cancellation method. Okay. Then we dive into chapter 4, which we learned about the accounting cycle. Now, for this class, I am not requiring you to know in depth, in detail of the accounting cycle. All I really need you to know is the order in which it goes in, because it's a cycle, right? When one step is completed, the next step follows after. Okay? All right, and in this class, right, like I said, at the end of the 15 weeks, you are going to take a look at all 10 steps of the accounting cycle. All right, but for now, I just need you to know just what the steps are and what order they belong in, because I will be asking you another similar question of what is an example, or which series of steps reflects the accounting cycle, right? So in this case, making sure that you know the exact order of how they come in, okay? Then we talked about the accounting period. That's very important, especially when determining when is the proper time to close out your books. So again, you can do it every day, every month, every week, every year, okay? And again, the definition of the accounting period is when you schedule to complete the accounting cycle. Now, of course, when we take a look at our fictitious business and actually complete all 10 steps of the accounting accounting cycle, you're going to notice that it will take a lot longer to close out a book. So if that's the case, right, if it takes about 2 weeks to close out books properly, then imagine what would be the best way to to completely close out your accounting cycle. Would be doing it every day be something that's necessary, or would you be better off doing it every year? Okay, so again, we'll determine that when we reach the last day in the 15 weeks of class. Okay. We talked about calendar year versus fiscal year. So basically, calendar and fiscal year is basically determined by when you need to, submit your taxes to the IRS. Okay, so whether you do it every start your accounting period on a calendar year, which is January, all the way to December, or if you choose fiscal year, right, depending on what kind of businesses you are, fiscal year is any 12 consecutive months, okay? And then, of course, we talked about the characteristics of the accounting cycle. I keep messing this word up. The 4 characteristics of the financial statements, okay, which is they have to be reliable information, right? They must be relevant in the time period, right? That all the transactions are within relevant time, okay? It has to be consistent, so using one type of method over using different methods every single time. And again, you want it to be comparable to not only to other businesses, but to also make sure that you are correctly compiling your financial statements, that it's able to be comparable to someone else in the same industry. Okay. Then we also talked about your ABCs, right, which is going to be for your generally accepted accounting principles. So again, you have your assumptions, your basic principles, and your constraints. As I've mentioned before, you are going to be tested on the first 8 accounting principles, okay? So again, your assumptions and your basic principles are the 2 main ones that you want to focus on, learning the ins and outs, the definitions of what they are, and being able to apply the knowledge for it. So I need you to make sure that when you understand business and economic entity, do you know Can you apply it to a certain scenario and be able to figure out this is the rule that governs it? Okay, so a great example, right, would be a business bank card, right? You have a separate business bank card and a separate personal credit card, right? That is what the business and economic entity does. It tells you that you must determine a fine line between making a business transaction from a personal transaction, right? And the best way to do that is by having a separate business bank card versus a personal bank card, right? So making sure you know the definitions of each and every single one of these, assumptions and basic principles, and being able to apply them and make examples out of them. Okay, because I will test you on them, and some of them can be very confusing. Okay, and again, constraints, I just need you to know what they are in regards to knowing that it's materiality, cost benefit, and conservatism, as well as industry practices. Once again, I do not need you to know the details, the definitions, or anything in regards to the constraints, because these ones are more for cost accounting or managerial type of accounting, where you're making those executive decisions based on those criteria. So in this case, constraints are not going to be on the exam. However, I need you guys to know it for the future. Okay? And of course, knowing the difference between cash basis and accrual basis. Okay, so again, cash, straightforward, right? You only recognize revenues and expenses when cash is either received or being properly spent. And of course, for accrual type of base accounting, you recognize revenues the minute that the minute that you sell a product or whether you completed a service. Okay, so you earn the revenue, all right, regardless whether you received cash or not. Okay, same thing with expenses. You don't recognize it until the job and task has been completed or whenever you receive a bill. So in this case, when it happened, so incurred. Okay. And then, of course, we'll talk about Chapter 5 and Chapter 6 tomorrow. Okay. With that being said, let's go ahead and dive right into, okay, where do you go? To the study guide. Okay. All right. All right. All right, so back to the study guide. So let's go ahead and answer some of these questions, okay? Okay. So in this case, I just placed it in order so it's easier to just go through the materials, okay? So number 1, all right. Okay, what is accounting? Let's see. A, it is the process of recording, sorting, and summarizing all business transactions, okay? Good. It isn't the process of creating formulas, okay? It is also not the process of elimination or the process of collecting data from business transactions, okay? So D only answers half the question, right? You don't stop at just collecting the data, right? You have to process it. You have to analyze it. You need to sort it, all right? And you need to record it. So A is correct. Okay. Number 2, okay? Which of the following areas of accounting does financial, managerial, and financial planning and treasury accounting belong to? private accounting. That's correct, right? In this class, right, we are learning financial accounting. Okay, so that's what this class is. It's learning the basics of accounting 101, which is starting you off with the very first one, which is financial accounting. The next steps after that is cost accounting, then managerial accounting, then so on and so forth, okay? But in this case, all you need to really know is that this class is for the private sector, and it is to teach you financial accounting. All right, number 3. Which of the following is not a business organization? D, all of the above are business organizations. Yes, right? We talked about what a sole proprietor, partnership, and nonprofit organization, right? Those are all existing types of business organizations, okay? Number 4, okay? Which of the following financial statements it is based off of the accounting equation? Okay, assets equals liabilities plus equity.
Is it B?
Okay, so let's talk about this, okay? So, when we talk about the financial statements, right? There are 4 financial statements. Obviously, it's not going to be the statement of equity because that just determines on your value of your company, right? In this case, it is not going to reflect the accounting equation. Now, if you think about the accounting equation, right? You have an equal sign in there, right? If there's an equal sign in there, then our first kind of thought is that you have to balance something, right? So in this case, it'd be the balance sheet. Profit and loss is going to be determining whether your company is profitable or not, okay? By taking all of your revenues that you've earned and counting them against all of the expenses that you incurred in order to operate your business. So in this case, profit and loss is not going to be the answer, okay? It's definitely balance sheet because you're balancing, right? All of your assets must equal all of your liabilities plus your equity. So in this case, the answer is A, balance sheet. Okay? Right? We're not going to get to learn all 4 financial statements until the very, very end of class. However, I do need you to know at least what they do in terms of why they are so important to accounting itself, okay? So again, understanding profitability is a very major one. Looking at what your net worth is, looking at how much cash is flowing into your company and how much actual cash is flowing out of your company, and determining your balance sheet, which is determining your total assets and your total liabilities plus your equity, okay? So those are very important for financial statements. Okay? All right, number 5. Let me push this forward. I think there's... Okay, never mind. Question number 5, okay? What is the difference between the accountant and the bookkeeper? A, right? Because the accountant's the one that creates the financial statements. They're the one who analyzes the business transaction, while the bookkeeper only records business transactions, okay? So I talked about and mentioned this earlier. Okay. All right, now we're stepping into chapter 2 territory here. So this is what I'm going to ask you on the exam. I will give you a specific account, and what your job to do is you're supposed to determine what account type, what category and what account balance or normal balance this account would normally have. Okay. So again, of course, it's not going to be listed exactly like this. I will give you each question is going to have a account. I'll give you the account description as well. And the answers are literally going to be the exact order that I want you to answer, right? I'm going to give you, like, for example, cash, right? I will give you the option whether it's an asset, current, and credit, or I could give you expense, operating, and debit. Okay? Or I could say asset, current, debit, right? And your job is to go through the answers and select which one is the correct one. Okay? So each account, I want you to determine the account type. There's only 5 account types, so you can't go beyond assets, liabilities, equity, revenues, or expenses, right? There's only 5 categories, okay? Where categories, right? This is where I'm testing you in chapter 2. You need to know which category each type has, okay? But of course, I'm also giving you multiple choice answer. So there's no mix and match here. There's no asset with a operating income or anything like that. No, it's pretty straightforward. If you're going to answer that the cash is an asset, right? What's going to be next, which is the category, right? So you have 3 categories you could choose from: current, other, and fixed. And then you have the other factor, whether it's determined as a debit or a credit for a normal balance. Okay, so that is what I'm going to be asking you on the exam. And there's 10 questions in regards to 10 accounts with 10 descriptions, and you need to determine what the account type is, what the category and normal balance is. Okay, so let's start with the very first one. What is cash? Okay, what kind of account type is cash? What was that? It is an asset. What kind of asset? Current. Okay, and what kind of normal balance would a current asset or a cash account have? It would definitely be increased by a debit. Okay, so this is where your accounting model will help you the most here. Okay, what about accounts receivable? What kind of asset?
Current.
It is 100% current, because what accounts receivable is, okay, it's basically when customers owe you money, right? And the way that we determine it, the category is based on how quickly can you convert this into cash. Well, it's quick because you can simply just go to your customer and ask them to pay. Okay, so that is definitely a current asset. And what kind of balance would this normally have? It would have a debit balance. Okay, so debit balance. Okay, what about inventory? It is an asset. What kind of asset? Definitely current. And what kind of normal balance would it have? Yes. Okay, so in this case, inventory, right? We could turn around and sell it the same day in order to receive cash. So that is why it is a current asset. What about equipment?
A asset.
Yes, it is an asset, right? You own the equipment. All right, now what kind of asset?
Current.
Okay, so this isn't a current asset.
Fix it as
It is 100% a fixed asset. So remember, right? If you remember it like this, PP&E is a fixed asset. P, which is property, so anything that you own, whether it's the land, whether it's the streets, the sidewalk, the parking lot, that's all considered property. Plant is your building and everything that's inside the building. So whether it's furniture, lamps, desks, tables, right? And then you have E, which is equipment. So any type of machinery that helps you operate the business. So in this case, it falls under the category of PP&E, which is also known as a fixed asset. Okay. And what kind of balance would this normally have? It would have a debit balance. Okay, because again, if we buy or purchase equipment, right, that increases our assets because we now own a machine. Okay, and of course, I gave you land, right? It's a fixed asset, right, because it belongs into property. Okay, and would normally have a debit balance. What about prepaid accounts? So anything that is prepaid, such as prepaid rent, prepaid insurance, right? Things that you've paid in advance for.
Liability.
Okay, so if you paid in advance for services, you don't technically owe anybody, right?
Yeah. Oh, yeah. It's an asset.
It is an asset. What kind of asset?
Operating.
Not operating,
Oh, wait. Current.
current.
not current. For sure, it's not current. Okay, so I've mentioned prepaid rent and prepaid insurance, right? If I've made a payment in advance to acquire these things, right, that makes it an asset. Now, can you actually touch rent?
No.
Can you touch insurance?
No.
No, so that makes it intangible. What category do I normally put my intangible assets in? Right, so take out your review sheet if you need to.
Other.
It belongs in other because in this case, right, prepaid rent, especially rent, and insurance are usually a lot harder to get your money back. Okay, especially rent because you have to deal with your landlord. If your landlord does not cooperate because you're under a contractual agreement, then you may have to take it to a lawsuit, right? And of course, if it's anywhere for a lawsuit, it could take anywhere from 6 to 2 years to get that money back. Okay? So in this case, remember, we determine our categories for assets based on how quickly you can convert into cash. Again, prepaid rent, it's definitely going to be the most hardest one to get your money out of it. Okay? All right, and what kind of normal balance would... Good. You would have a debit balance. Good. Okay. What about accounts payable, where you owe money to other people? It's 100% a liability. Now, what kind of liability?
Sales?
It's not technically a sales, right? Because if I'm owing money to other people. Okay, so let's go ahead and pull up that Chapter 2 review sheet. What are the categories for liabilities?
Liabilities and long-term liabilities.
Current and long term. So, how do we determine how we categorize our liabilities?
I would say it's a current liability.
It is current because how we categorize our liabilities is based on how long you owe them for. Now, of course, many companies, if you owe them on an account, they'll typically only allow you 30 to 60 to 90 days to owe them. So in this case, right, how we determine is how long. So usually the cutoff point is within a year is a current liability. Anything longer than a year becomes a long-term liability. Okay, so think of it that way, right? Long-term, longer than a year. Okay, so it's current for sure. Okay, now what kind of normal balance would a liability account have? It will have a credit balance. Okay, now let's take a look here. What about unearned revenue? Unearned revenue is when customers pay you, the company, in advance for services.
Does that come under income?
In this case, did you earn the revenue yet if you haven't completed the service? If you got paid in advance for a service you haven't completed yet? No.
So does it become a liability because I haven't done it yet?
Correct. Therefore, you owe this person service, right? If a customer comes up to you and says, "Here, I'm going to give you $100, paint my door," but you accepted the money, but you said, "I can't. I'm busy this weekend. I'll do it on Saturday." That right there is an example of an unearned revenue because someone gave you money in advance to do services for them, but you haven't done the service yet. You haven't earned it yet. Okay? Hence the word unearned revenue. Okay? You haven't earned it yet until Saturday comes when you finally complete the task. That's when you recognize that a revenue has happened. You earned it. So this again, it's an advance payment for services that haven't been completed yet. So it is 100% a liability. And again, what kind of liability would it be?
Other?
Is there such thing as an other liability?
Just current or long term?
Current or long
So both
term?
current if it's under a year?
Yes, most likely a lot of unearned revenue is going to be current. The only exception to this one is construction, obviously, right? If you try to build a building, it's not going to happen within a year, all right? However, that's going to be, we'll talk about this in QuickBooks where you can pay off certain sections when you complete a specific task. Okay, so it's not like the whole thing is within, okay, I give you a span of a year to build my building. No, it doesn't work that way, okay, especially when it comes to construction. But most cases, right? Would anybody pay you $1,000 to paint your fence and expect you to paint it the year later? Most likely not, right? All right. Another exception to this would be wedding venues, but again, wedding venues they require deposits and stuff like that. So in this case, that's also another exception to this rule as well. Okay, but most likely a lot of unearned revenue would most likely be services that are going to be provided within a year versus the other way. Okay. Okay, and then lastly, what kind of normal balance would a unearned revenue have? Credit. Good. Good. Okay. What about a loans payable?
That would be another liability, correct?
Yes, it's a liability. Now, what kind of liability?
Does it depend on the loan terms, or is it just going to be a credit?
Most likely, what are typical times and length of a loan? What do you see more often? Yeah, so in this case, it'd be a long term liability, right? Now, in this case, right, if it was a short term loan, obviously it will be stated that it's a short term loan, but you're more likely to see like a minimum would be, you know, what is it? 12 months, 24 months, or 36 months, okay, which is definitely longer than a year, okay, but most consumer loans, if not, they're anywhere from 3 to 10 years, or if it's a home loan, again, property management, if you actually buy a building, that could be anywhere from 20 to 36 year loan. Okay, so again, it does depend on what the type of loan it is, but most common that you would normally see is that they typically would give you a loan that's more than a year long. Okay? And again, if this is a long-term liability, what kind of normal balance would it have? Credit. Okay. All right. What about owner's equity? What type of account is owner's equity?
Just go under owner's equity.
That is correct. It's just owner's equity. Okay. Now, what kind of category does owner's equity have?
None.
None, right? Now, in this case, owner's equity, right? It's determined based on the value of the company, right? They usually refer to owner's equity as your original investment when you started the company, and you would debit or credit the owner's equity depending if you are reinvesting more money into your company. So, in this case, what kind of normal balance would owner's equity have?
Credit.
It would be a credit. Good. Now, let's take a look at this one. What about an owner's withdrawal? What kind of account is owner's withdrawal?
An expense?
It's not an expense.
Owner's equity.
It is owner's equity, okay? Because it does affect the company itself, the value of the company. Of course, this doesn't have categories, but let's talk about what owner's withdrawal does. Does it increase equity or does it decrease equity? It decreases, right? Because you're taking money away from the company. You're not investing more money, right? In this case, it will 100% decrease equity, meaning it will decrease the value of your company. So in this case, which way or what kind of normal balance would an owner's withdrawal have for an equity account? Not credit. If credit increases it,
Debit.
it would debit it, correct, because it's going to decrease the owner's equity.
Teach.
Yes.
Teacher. My my answer, David, depends on the any withdraw means cash or checking. In this case, cash or checking account, it is credit.
Correct.
Mean, means owner withdraw debit.
Yes.
This is why I said debit.
That's correct. You're correct. If we're applying it to a double entry system, right? That's correct, right? If you're gonna take money away from the company, how are you gonna take it away? Well, you need to decrease your cash flow, right? By
You-
increasing your owner's withdrawal. That's correct.
Thank
All right. So again, owner's withdrawal is going to be one of those accounts that decreases equity. Okay, and we'll talk about a lot of other accounts that do, flop here back and forth between the debits and credits as we go deeper into the accounting. Okay. What about sales? What type of account is sales?
And sales account?
Okay, sales is
I mean, as
you. Revenue or
revenue.
income.
yes, whichever one you want to refer it as, whether it's income or revenues. Okay, now in this case, right, what kind of category would sales belong to?
Sales.
It'd be sales, right? Because we're in this class, remember, we're looking at a merchandising type of operations. So in this case, if it'd be operating activity or also known as your sales because that's our main core of operations, right? We are here to sell merchandise. So you could either have it sales or operating, whichever one is on the exam. But on the exam, it's gonna be sales. Right? All right. And what kind of normal balance would sales have?
Credit.
Credit. Good. Okay. What about cost of goods sold? What kind of account is cost of goods sold?
An expense?
It's definitely an expense account, right? Cost of goods sold. Okay. Now what kind of category does cost of goods sold belong to?
The cost of goods sold.
Right, good, right? COGS for short. Okay. Cost of goods sold, right? It has its own separate category because this one is directly correlated with selling inventory, okay? All the other expenses, okay, whether it is rent or supplies expense, okay, those ones do not contribute to inventory at all, right? How is rent directly correlated to inventory? It's not at all. Okay, so that's one thing that you need to know here is that the cost of goods sold is directly correlated to inventory. So again, this is a way that we can expense or get rid of or to sell our inventory items. Okay. Now, in this case, right, what is the normal balance for this cost of goods sold?
Always credit.
Not credit. Let's take a look at that accounting model. How do you increase the expense account? You would normally increase it on the debit side, right?
Yeah, the debit.
Okay. If it's not credit, it's going to be debit. Okay. So what about rent expense? What kind of well, obviously I just kind of gave it to you, right? It's kind of given into the word as well. Rent expense is going to be an expense, right?
Mm-hmm.
Same thing with supplies expense. Supplies is going to be an expense account. Now in this case, what category does rent and supplies expense fall under?
Operating.
Operating, right? It's these expenses that you incur is what helps operate the business, right? It helps run the business. So again, rent expense. You need to have rent expense in order to, have a place to sell your items, right? And again, what kind of normal balance would both rent and supplies expense have?
Debit.
They would both be increased by a debit, okay? So once again, this is going to be something that I'm going to be testing you on. I will give you descriptions with each account, so don't worry about that. I'm not expecting you to remember any of it except for the second exam. Once we take a look at accounts and we talk about them frequently, you don't need descriptions for them, okay? But for the first exam, you will have an account. You'll have a brief description of what it is, and you are going to determine the type, the category, and the normal balance. So use the exercise from chapter 2, okay? Because that's a perfect example, right? I give you the account name and I give you description, and your job is to determine the type, category, and normal balance, okay? So that one has a list of a little more extensive on different accounts, okay? But yes, so that is what I'm going to be testing you on this exam. What does left mean?
Debit.
It means debit, right? It does not mean to increase or decrease. Okay. What does right mean?
Credit.
Credit. Okay. All right, question number 11. If your company had a total assets of 125,000 and a total liabilities of 45,000, what is the total equity?
D.
D, 80,000, right? This is a
Yes.
perfect example of how to use the accounting equation, right?
Yes.
If your total
Ac-
assets is equals 125,000, right? Which equals your liabilities of 45,000 plus your equity, so E for equity. How do you solve for your equity, right? You would just subtract 45 from the 125,000 and you should get 80,000. Okay? Okay? Number 12, okay? Which account type normally have a debit balance? Maggie, can you mute your mic?
A.
A, assets and liabilities, okay? When we talk about the normal balance, right? We're talking about
And also,
which side increases
Oh.
on the debit side.
Oh, C. Sorry.
yes. See.
Okay, yes, assets and expenses are always going to be increased by a debit. Okay, everyone else, right? Credits is going to be liabilities, equity, and revenues. Those are all going to be credit accounts. Okay, good. Number 13, which of the following account type are temporary accounts?
B.
B, right? Revenues and expenses, right? These are the only accounts that close out at the end of the giving accounting period, right? Think about what I was talking about earlier, right? If I close out my bank account, which is my asset, right? What does that tell everybody? It tells everybody that I'm no longer doing business because I closed out my bank account. Okay, so think of it that way. That's not the best way to measure profitability either, right? Where revenues and expenses, right? You're always going to have a different amount of revenues and a different amount of expenses per case, right? If it's every month is your accounting period, right? Every month you're going to have a different amount of revenues, right? You're going to have new customers. You might lose customers. You might have the same customers that come in, buy the same thing over and over again. Where expenses, same thing here, right? You're going to maybe encounter advertising expense this month, but not the next month. You have to pay rent this month, and it's the same thing for the next month, right? You're going to have different fluctuations in between the revenues and the expenses because you can never predict what revenues and what expenses you can have for a given month. Okay? So yes, this is a perfect way to measure profitability. So you would close those accounts out. Okay. Next chapter we have here is chapter 3. Whoa. Okay, so chapter 3. Okay. Question 14. When journalizing a transaction, which statement is true?
I would say A.
A, your debits must equal your credits. Correct, okay? That's the purpose of a journal, right? Is that your debits equal your credits, because when we use the double entry system, right, that's exactly what we have to do. If you have an action, you need to have an equal and opposite reaction, right? So in this case, if you have a debit, you must have an equal number of credits. All right, number 15. Okay. That says what are the methods used to correct errors in the journal? A and B, okay? A and B only. So again, error cancellation and reverse and re-entry. Okay, I never talked about the cross out method. Okay, so A and B only. Okay, so let's take a look here. Okay, so you made a purchase of office supplies for $56 cash. Okay, and you recorded it in your books as office supplies for $65. All right, correct this error in the entry using both methods. So let's talk about the first one, which is the reverse and reentry. So in this case, right, I bought office supplies for $56, but I journalized it as if I put in $65 instead. So how do I correct this error using the reverse and reentry method?
You debit cash 56 and credit office 56.
Good, right? You're going to first reverse the entry, right? Okay, not for 56 though, because in this case, right, I entered it in, correct? I entered it in as 65. Okay? So then how do I fix this?
So you would credit cash. Yeah, credit cash of 56 and then debit it to office.
Good, good, good. So this is how you do it, right? The reverse and re-entry, right? You need to reverse the transaction. So in context, right? If I went to the store and bought office supplies, right? This is what I have to do. I have to go back to the store, return the product, right? For the amount that I wrote in my journal. And then I'm going to repurchase it for the correct amount. Okay, which in this case, right? I'm going to rejournalize it for the correct amount. Okay. So that's the reverse and reentry. Now let's talk about error cancellation. Okay. How do I journalize the error cancellation here? I need to determine two things. Okay. I need to determine what's the difference between the mistake. So what's the difference between 65 and 56?
Mine.
It's
$9.
good. It's $9, right? Now, here's the question. Which account is overstated or understated? So in this case, if I originally purchased my office supplies for $56, but I recorded it at 65, which account is overstated?
Cash.
Cash is not overstated. Actually, yeah, cash is not overstated. Actually, yes, you're right. It is overstated. But how do I determine which account I'm going to be debiting and which account I'm going to be crediting? So if I have too much cash, right? Does that mean I have too much office supplies?
No.
Okay, so if I originally only bought $56 worth of office supplies and I recorded it for 65,
You would debit office supplies.
I would not debit office supplies. I have too much office supplies because I'm supposed to only have $56. But because I made the mistake and recorded at $65, so I have too many supplies. So my office supplies is overstated. Now my cash is also overstated because I spent too much money when I really didn't. Right? I didn't spend $65. I only spent $56. So in this case, my accounts are both over. Right? They're both overstated. So in this case, how much do I need to decrease a specific account in each one for $9? In this case, I have too much cash, right? So therefore, I need to debit my cash account because I spent less. Same thing with my office supplies, right? I need to decrease my office supplies because I have too many office supplies, right? I have $9 over in my account. So in order to use the error cancellation, I need to figure out which account has over and which account has under. In this case, these two accounts here are both over, right? They're not under. So again, my original journal was, I journalized it for $65 when I really only bought 56. So therefore, I need to debit my cash because I didn't spend that extra $9, and I need to credit my office supplies because I didn't spend that extra $9 to buy more office supplies. I spent only $9 less on office supplies, okay? Is this one clear?
Yeah.
So again, error cancellation, once again, I find the hardest one because you have to determine, right? You have to think really carefully because you don't want to make another mistake and end up overstating your office supplies again, and then overstating your cash account again. Okay. All right, number 17. Okay. What is the difference between the general journal and the general ledger?
C.
C. Let's see. The general ledger is a list of all accounts with balances. Okay. So C is correct. Let's see. General journal has a list of all the transactions with balances. No, that's not true. The general ledger only lists the daily transactions. So in this case, letter C is correct, right? The general journal is a list of all the accounts with their account balances. Right? Good. All right, last chapter here, chapter 4. Okay. So, number 18, which of the following steps belong to the accounting cycle?
Teacher,
Yes,
I need explanation. Or for this, I need 7 steps, and this is a 10.
that's transaction analysis. Transaction analysis is 7 steps. In this case, this is the accounting cycle. The accounting cycle has 10. Okay?
So it's D.
So it's D, all of the above. Yeah, that's correct. It's all of them. Okay? So again, in chapter 4, right? If you remember, chapter 4, I list out all 10 steps to the accounting cycle. Okay? Your transaction analysis has 7 steps, which only take you up to step number 3, which is to journalize it in the journal. Okay? While the accounting cycle takes you all the way out to completing the financial statements, to closing out the books, all the way to the post-closing trial balance. So in this case, this one is a lot more extensive than the transaction analysis. Okay? So D, all of the above is correct. But once again, I will be testing you something similar to the quiz. All right, I'll give you a series of a bunch of steps. Okay, and in order for you to get to answer that question correctly, is that make sure you answer the one that is the most accurate in the most correct steps. Okay, so I make sure that it is step 1, step 3, step 5, step 8. Okay, in the most correct order as possible. Okay. All right. Question number 19. Which of the following is not a characteristic of financial statements?
D.
B, that right? It should be reasonable, but obviously, if it's reliable, that's pretty much the same thing as reasonable, right? Because reliable, right, is basically proof that you have a transaction that happened. So again, reasonable is not one of them, right? We only learned the 2 R's and the 2 C's, right? Reliable, relevant, consistent, and comparability, okay? So in this case, reasonable is not going to be a characteristic. Right? Number 20, okay, under the rules of GAAP, which rule states that personal assets should be separate from business assets?
A.
A, business or economic entity. That's correct, right? That's the big, huge, that's the definition right there, right? Separating your personal from your business is important, okay? So yes, business, economic. Now, of course, I will be adding in things that are from the constraints and, conventions, but remember, all right, if you can remember this one thing, I'm not going to test you on any of those. Then you should be using the process of elimination. Okay. Number 21, under the rules of GAAP, which rule states that when recording a transaction, it should be recorded in terms of money or value?
B.
B, historical cost. No, that's not correct. Okay. So B, right, historical cost means that the day that you purchase the asset, right, it must be recorded at fair market value, which is the price that you purchased it that day. Okay. Now in this context, that's not what I'm asking you. This one tells me that I have to record in terms of money or value, meaning I cannot put I bought 20 periodic inventory items. I bought 20 mugs. No, I cannot put that. I have to put the value and the total cost it took me to buy 20 mugs. So which rule states that?
Is it C?
Monetary assumption. Pretty straightforward, right? As long as you're using money, that is exactly what it's asking you. Okay, good. All right, number 22, under the rules of GAAP, which rule states that when making a purchase of assets, okay, they are recorded at original selling price. This value does not change over time.
B.
This is the historical cost, right? Where I'm purchasing them at original cost or fair market value. Okay, so this is a good example of that one. Okay. Number 23, okay? Cash basis is when?
D.
D, A, and B, right? So revenues are recorded when cash is received. Expenses are recorded when cash is readily available to spend. Okay. Last question here is what the accrual basis is when.
Wait, go back. Was that D as in dog or B as in boy?
D as in dog. It's A and B.
C.
Okay, for this one, for the accrual
24.
basis, it's going to be expenses are recorded when incurred, right? Regardless whether you receive cash or not, you're going to record it whenever it happens. Okay, so same thing with revenues, right? When you earn it, the day that you complete the task or sell the product, you've earned the revenue. Okay, whether you received money or place it on an accounts receivable, right? You sold the product, that's the end of the deal. That's the end of the day. Okay, same thing with expenses, right? When you receive a bill because a service has been completed, you're going to record that expense because that is when it happened. Okay, whether you paid it off or whether you owed it on account, it doesn't matter. The key factor here is that you're recording it as it happens. All right, good job, everybody. So that is it for today, right? Tomorrow we're going to continue on with chapter 5 and chapter 6 review, okay? Any questions so far in regards to the first 4 chapters?